I think it's always very tempting to look at our portfolio and kind of pick the brands and the names that you recognize most, perhaps as a consumer. We've got 56, 57 different companies in our portfolio. They span from enterprise software to healthcare, B2B services, consumer platforms. We are seeing across the board 18% EBITDA growth, 12% revenue growth organically in that. And overall, in an economy which is kind of a little bit half lackluster, there's a lot of growth, a lot of opportunity for us to invest in, and that's what we focus most on.
I think for a lot of companies, having their AI portfolio right is a big point from here, because every company in tech universe is meant to be an AI company. We've heard that from a lot of venture capitalists as well and private equity investors. I just went onto Squarespace and thought I'd go down the track of building a website. It's a fascinating option. What are you seeing in terms of the companies you're willing to invest in tech world at this stage?
So we are super lucky in the sense that we've been investing in tech since the inception of the firm kind of 40 years ago. I started working with Permira 28 years ago in the dot-com boom, and the firm is really tech-centric. So the largest segment that we have is investing in software. And then the second largest is investing in consumer digital stuff. You mentioned Squarespace, you mentioned AllTrails. And because of that, kind of everything we do, whether it's a consumer brand or a healthcare company or anything else, has tech in the background and in the fabric. So when the consumerized AI revolution really started coming through in force, a couple of years ago, we've been driving machine learning and AI in the portfolio a lot longer than that. We took that opportunity, and you see every consumer-facing internet company we have, every software company we have, there's a huge drive to use AI both in the background for better decisions, better outcomes, better processes, and in the foreground for the user experience.
That has been a successful strategy for a while now, but there's a different tech in the room, and that's called AI, and as a result, it's driving the way investments happen. And I'll throw a couple of names at you, Mistral AI, NVIDIA, names that are just attaching huge multiples to them almost instantly, making other technology look like it's in the slow lane. What do you do in that context where some of your clients, investors are demanding big multiples, but you may not be getting them from slower moving tech these days?
So what we're doing in that space is, our mental model for AI is there's infrastructure, there's the models, you mentioned Mistral, and then there's the application layer. We think the money is actually for us to be made in the application layer and in the infrastructure layer. So you see us investing in everything from land banking to looking at how we build the infrastructure for that. We don't invest in the models, at least currently. We think they're hard to price, and as you said, the valuations are really huge. So we'll let other people do that. And then we invest mostly in the application layer, which is, okay, how do you use AI in your daily life, either as an enterprise or as a consumer? How do we take the benefit of what comes from those models, which are commoditizing, and plug it into your user experience? And then how do we create the infrastructure circumstances for that to happen? And that's how we think about it and where we invest our capital.
That's fascinating. Can I take a step out? And I think that's a fascinating look into your decision-making on technology. I actually want to know about the private equity industry at the moment and what Permira is up to as well. You occupy a space which comes after VC historically, but that's blurring as well. You have a relationship between the private and public markets, but the public markets we know are under a lot of pressure now as well. So do we stay longer in the private sector? And of course, the relationship between the private sector and leverage, I think, is also coming under focus. So I've raised three issues there as well. Can you just tell us a little bit, but from your point of view, how you see the evolution of private equity at the moment?
Yeah, so there's a couple of, I think, key things happening there. One is that the segmentation is moving from a product segmentation, you know, are you a VC investor, growth investor, buyout investor, or public market activist? From there, it's moving to a thematic investor. So are you a world-class investor in the topic that you asked about, which is how do you apply AI to technology and technology to for example, consumer internet? Or how do you apply AI to healthcare product development, pharma development, and so forth? And if you're great at that, then you'll be able to invest across the growth space to the buyout space and maybe even to the public space.
Is a huge answer. actually, because you're basically saying the differentiation between the various classes from activist to PE to VC, and it's something that we've talked about a lot earlier in the year last year. It's eroded. It's all about theme now rather than the stage of investment that you make.
That's strongly the point of view that I hold and that we as a
What does
firm
that
hold.
mean, though? Because VC have to hang on a really long time. They have a high failure rate. It's all part of the model. Private equity, historically, the holding period, and you'll correct me, I know, but it's somewhere between 3 and 5 years. Activists tend to be even shorter time frames. Get in, make your point, make your win, or get out. So that's complicated.
I don't think it's complicated. I'll give you an example. So Genesis, we bought that out of Alcatel-Lucent in 2012. We still own it. And it's gone from being...
That is very rare.
We bought it for $1.5 billion, give or take, and it's worth like 10 plus x that, give or take, today. And the reason we've held on to it is because there's an incredible runway in terms of the market opportunity, the product development, the go-to-market, and everything we can do. And the private equity or private markets business model allows us to do that. What differentiates... You asked about different things that is happening in our industry. I think another big difference is that we are a private partnership and we are committed to remaining a private partnership, and that means that we're not distracted by any other demands on what we do. So we can say, okay, so we don't have a public listing to our share price. We focus on what we believe in the long run is best for the portfolio companies that we invest in and is best for our investors. And then kind of our interest follows from all of that.
My final question, because Karen's got one as well, but my final question is, but the returns then, the profile of returns for each of those different kind of investors who are now, in your world, becoming thematic investors, is very different historically. What the VC expects out of return, what you've expected out of return, and I appreciate the exponential, the X return you've had out of that asset you just talked about there, and compared with what the activists want as well. Are you having to change the parameters, even though you're a private partnership, of what you expect from each of these investments?
No, but we're accessing that opportunity in different ways. So if you take a company and you fivefold its EBITDA, there's plenty of opportunity for every asset class in your definition. We invest in private credit in growing companies. We invest in private equity in the growth phase, in the more mature phase in every company, and we ping at it from different directions, enablers, applications, and so forth. And that's kind of how we think about the world and our themes. And for us, it's all about the thematic depth and having world-class talent in identifying and driving value creation in the themes that we know and love. And it's kind of that simple.
I don't know about you, but I've been somewhat encouraged when I've gone to technology events in recent years that Europe was playing catch up, that you were seeing more private money allocated to really exciting European technology. But it feels like we've got something coming, and that is much looser regulation in the United States, much tighter regulation in Europe, and a bigger gap in that regulatory landscape that may benefit US companies and stop some of the progress. Is that a genuine fear, or am I overreacting?
I think we have the perfect vantage point on this question, right? So of our capital deployed, I think 47% is in North America, 44% is in Europe, and the rest is in the rest of the world. Right? So we are genuine transatlantic plus investors. And we've got in tech, it'll be a similar reflection to that. So, we just bought Adevinta in Norway, consumer tech or consumer internet. We just bought Squarespace, same segment, Europe, US. And our approach is, again, it's priced in. So you look at what's happened with the US stock markets and the European stock markets, there's a divergence on that. We can find great opportunities in the micro to grow companies and profit pools both sides of the Atlantic. It's just about picking the best ones. And we think that it's a huge strength to be able to kind of asset pick in North America and in Europe and a bit elsewhere when it's thematically consistent rather than a fear.
Indeed. And just finally, the IPO market. What's coming? Are any of these companies that are great opportunities coming to public markets soon because the environment's changing?
I think you probably would get better answers from other guests on the IPO markets, because again, we're sort of pretty myopic on this. We just say, look, we build great companies, and if you build great companies with strong profit pool growth momentum, ultimately there will be an exit for them. Whether the exit is to the public markets which are a bit episodic when you look at it over the decades, and that's okay, or to other financial buyers or to strategics. And that's how we do it. I think, as you said, I think the euphoria around the US market and what's happening there at the moment is probably going to create a bit of a pull. That's great. It is going to leak somewhat into the European markets. That's great, because they're not isolated, but we'll see. We're fairly